Imagine waking up on a Tuesday morning, grabbing your phone, and seeing that Coca-Cola just dropped some cash straight into your account overnight. You did not work for it. You did not sell anything. It just showed up. That is what dividend investing feels like. But then there is another group of investors. They do not care about that. They just buy one simple fund, set it on autopilot, and do not touch it for 30 years. No stock picking. No checking dividends. Just patience. So which one actually wins? Today, David is breaking down dividends versus index funds. Not just the numbers. The real difference in how each strategy feels, how it performs in retirement, and which one actually fits your life at 25, 30, or 35 years old. David started investing at 23. Fresh out of college, first real job, first real paycheck. He opened a brokerage account and immediately started looking for dividend stocks because the idea of getting paid just to hold a stock felt like the smartest thing he had ever heard. He bought Coca-Cola, Johnson & Johnson, Procter & Gamble, solid companies, companies that had been paying and growing their dividends for decades. Every quarter, small amounts of cash started hitting his account. $30 here, $50 there. It felt real. It felt like progress. It felt like the money was working for him. But then David sat down one afternoon and actually ran the numbers against a coworker named Mike. Mike was doing something completely different. Mike was not picking any stocks at all. Mike was just putting money into a single S&P 500 index fund every single month and forgetting about it. Same salary. Same amount invested every month. 5 years in. Mike had more money, not because Mike was smarter, not because Mike worked harder, because the S&P 500 had outperformed David's dividend portfolio in total return over those 5 years. And while David was paying taxes on every dividend payment whether he wanted to or not, Mike's money was compounding without that annual tax drag. That moment forced David to actually understand what he was doing and why. And what he learned changed how he thought about both strategies entirely. Here is what David figured out and what you need to understand before you pick a side. First, let us talk about what dividends actually are. When a big established company makes more profit than it can reinvest back into the business, it returns some of that profit to shareholders as cash. That cash payment is the dividend. Coca-Cola, Johnson & Johnson, and companies like them have been doing this for decades. Some have increased their dividend every single year for 25 years straight. Those are called dividend aristocrats. The dividend yield is simple math. Annual dividend divided by share price. If a stock costs $100 and pays $4 a year, the yield is 4%. Now, here are the real advantages of dividend investing. You never have to sell your shares to create income. In retirement, that matters psychologically. When the market drops 30%, if your dividends keep coming in, you can stay calm instead of panic selling. That emotional stability is worth something real. Dividends also tend to grow over time with good companies. That means your income can keep up with inflation without you doing anything. But here's what most people miss about dividends. The dividend is not free money. When a company pays a dividend, its stock price typically drops by roughly that same amount on the payment date. Your total wealth does not magically increase. The money just moved from one pocket to another. And you now owe taxes on it even if you reinvest every dollar immediately.